As expected, the Federal Reserve is keeping interest rates steady. The move comes as the Fed continues to deal with inflation. The current range of 5.25% to 5.5% has now been in place since July 2023. It's the highest level in more than 20 years. For more on the Fed's decision, we're joined by Jeanna Smialek. She's Federal Reserve and economy reporter for the New York Times. It's good to be with you again. What did you make of what Chairman Powell said today?
Yeah, it was largely as expected, but I do think one thing stood out, which is that Chair Powell made very clear that the Fed is not considering additional rate increases at this point. He was very clear that it is unlikely that the Fed is going to raise rates further, and really sort of put all of the eggs in the either the Fed is going to cut soon or the Fed might, hold rates steady basket, where the conversation we're having is clearly one about are rates going to come down and how quickly is that going to happen?
And do we think if they're going to come down, there was talk at one point of 3 rate cuts in a year. That can't be possible anymore. Are we thinking 2? Could that still be possible, or is it really just realistically possibly only 1?
Yeah, so he really avoided answering that question, which he got asked very specifically. But I think if you look at where investors are pricing things at the moment, it seems like the most likely outcome is 1 or 2 rate cuts by the end of the year. Most Wall Street economist firms will tell you that that's kind of where they are. They're mostly predicting 1 to 2. And it does seem like the Fed is just running into the calendar at this point.
Right.
They do not really have time to make those 3 rate cuts anymore, and especially given that it's pretty clear they're not going to cut rates in June. So I think that it's a timing issue at this stage.
You reported this week that some lower income earners are feeling the effect of rate hikes more than middle and upper income households. Why is that?
Yeah, so low-income households always feel the effects of rate hikes, and they usually feel them 3 ways. They feel them through credit card rates because they're much more likely to borrow on credit cards. They feel them through auto loan rates because they're much less likely to buy their cars outright. And they also feel them in the sense that it usually is the case that when you have higher Fed interest rates, people lose their jobs, and low-income earners tend to be the first people to lose their jobs. So that final leg of the stool, they are not feeling this time. The job market is still very strong, but the other 2 are really acute this time. We've seen delinquencies rising on auto loans. We've seen credit card rates in excess of 30%. And obviously mortgage rates, to the extent that people are trying to buy houses, mortgage rates are also very high. At the same time, richer households usually feel the effects of rate hikes in a couple of ways. They feel them through lower stock prices, and they feel them through lower housing prices. But that channel, that's the one that's really not playing out this time. We've stocks came off in April, but in general, they've been very strong, and we've actually seen home prices continue to rise. So it's been a different time.
I also, speaking of different times, you wrote Wednesday about former President Trump's plans for the Federal Reserve if he wins in November. Tell us about what the thoughts are about how he would treat the Fed.
So the Trump campaign itself has been very quiet about this particular topic. What we have seen from former President Trump out on the campaign trail is that he's clearly very willing to criticize the Fed in public, just as he was when he was president. That's something Joe Biden has avoided doing out of respect for the Fed's independence. But President Trump has already said that if the Fed cuts rates before the election, they're going to be making a political act to help Joe Biden. So he's clearly willing to sort of beat up on them just verbally. I think the real question, and what you're seeing percolate among some Republicans and what my colleagues have reported on, is this idea that, he could go further than that he could try and have some sort of oversight of Fed regulation, and that he could do things to sort of infringe upon Fed independence in a more sort of serious and maybe effective way than just yelling at them from the bully pulpit. And so that's the big question. And we will be looking to see if his campaign starts to embrace that language. Because as I said, up to this point, this is really outside people. And the question is he going to adopt it as well?
More effective politically, which is to say, give me the general principle as a last question. What's the general principle of why the Fed needs independence and what might be in danger if the former president's reelected and is more effective in his jawboning of the Fed?
Yeah, so the Fed has historically been insulated, particularly on the monetary policy side of things, because the idea is you don't want a sitting president to have any real say in where interest rates are. Sitting presidents always want interest rates to be very low because they're great for growth. That's great for growth. It's good for their reelection chances. But if you have interest rates too low all the time, and if you never raise them, you're not willing to sort of take the threat of a slower economy, you're really risking letting inflation jump out of control. And so for the health of the country in the longer term, to make sure inflation stays under wraps, you want to have an independent central bank. And a lot of research suggests that this is best practice, not just in America, but sort of around the country, places that don't have independent central banks. You can think Turkey, you can think Argentina, tend to see problems with inflation. And so I think that's really the crux of the issue. Fed independence is important for keeping that inflation rate under control.
Jeanna Smialek, Federal Reserve and economy reporter for the New York Times. Thanks so much.